Hello and welcome into the Retirement Playbook. This is your host, Brock Alspaugh, brought to you by Alspaugh Wealth Management. We're here all the time, ready to help you and your family get to and through retirement. Today, we're also joined by my normal co-host. His name is Tony Shore. Hello, Tony.
Normal. You use that. You might want to put quotes around that for those that know me. Normal, yeah. Great to be here with you, Brock. I love doing the show with you each week. I am pumped up to talk to you today.
I know, me too.
Because look at that, a nice cold glass of water. I love that. Now you're making me, you're making me thirsty. All right.
So we digress.
Well,
listen, we've got a great show lined up for you today, folks. And if you're wanting to tune in and listen about a very timely topic, and it's interest rates, where we're at, where we're going, where we've been. And so we're going to talk about that today and how it relates to your wallet, right? We don't want to just talk about stuff that's going on without it relating it to you and how it could help you in your life. So we're going to talk about that today. But before we do, I want you to go to our website. It's alspaughwealthmanagement.com, alspaughwealthmanagement.com. You can check out past shows. You can actually just go ahead and request an appointment with us. What will happen is that you click that button, you fill that out, and it gets sent to us, and we'll reach out to you and see what, is going on in your life. See what, maybe it's just a conversation that we have. And if you have questions or if you need a little bit of advice, great. But ultimately, if you need to go through an entire comprehensive plan, which I recommend everybody do, then you can just give us a call at 573-332-7855. Okay. It's not easy. I get it. But really, there's people out there that do make it easy for you, as far as figuring out where you're at, where you're going, and how we can help you get there. So, again, give us a call at Alspaugh Wealth Management, and we'll do what we can to help you in any way we can. All right, Tony, you ready for today's show? We got some big news, man. We can't just get into interest rates. I mean, whether you like it or you don't. I mean, 50% of the country is not happy with the outcome of the election. But the fact is Donald Trump is coming back in as the 47th president starting in January. And it actually is very relative to our conversation today because, we're talking about interest rates. We're talking about the Federal Reserve. We're talking about what that means to you. But, when we're talking about who is president, there's a lot of influence there, as far as, where interest rates go. Now, he's not the chairman. He can't make decisions on what, the Federal Reserve does and Jerome Powell. Now, he can remove Jerome Powell if he wanted to, and the president of the Federal Reserve. But anyway, the point is that, President Trump has mentioned that he wants to, keep rates a little bit lower to help spur the economy and, interest rates. You're borrowing money. That's, it's the engine. So, so we'll see what happens. We'll see what happens with that. But, we'd be remiss if we didn't bring up the old election results. So, once again, stock market going crazy. So we'll see what happens. I always tell people, look, don't base any investment decision based on who you think might win or who does win. Right? That's called emotions. And we don't want to make investment decision based on emotions, right? So whether you're happy or whether you're not happy, doesn't matter. Don't include that in anything you're deciding about your investments, So anyway, there you go. Tony, you got anything to say about that?
Well, yeah. I mean, today is a huge day. As of this recording, we are recording this the day after the presidential election.
Right.
And Trump and the Republicans won handily. Just kind of a sweep for Trump, and the Republicans, I believe, are taking control of the Senate the way it looks. Mm-hmm. So it's a huge day, and no matter what side of the fence you fall on, this is big news. And it's also the day or the week that the Fed is going to decide whether they're going to lower them again. And we're going to talk about what effect the first time they lowered it has been and will be on you. So lowering interest rates, how does that affect you? How has it affected you?
Yes.
Does it directly affect you? I'm glad you're going to answer some of these questions today, Brock.
Yeah, absolutely. So let's get to it. How about it?
Let's jump in.
Okay. So let's do a little recap here. So we started raising rates in 2022. And the reason why the Federal Reserve decides to raise rates, at least the benchmark as to what they told us, is that when inflation starts to go a little bit higher, what happens is the Federal Reserve says, okay, well, we're going to, and they use employment and some other things, but the main factor that determines where they're going with interest rates is inflation, or it has been anyway. And so inflation, as we all know, was getting crazy high, and it's coming down. But when that happened in 2022, they started raising rates. Finally, they probably should have done it before that, but that's a discussion for later on. But anyway, so they started raising rates. Well, now that inflation has come down to a more reasonable level to hit their benchmarks, they've decided to reduce rates. And so in September, Tony, the Federal Reserve dropped the interest rate down 50 basis points. Okay. And so that range is, 4.75 to 5%. And so what does that mean?
Yeah.
Well, you've seen a lot of, and I don't know how many people do commercial loans, but commercial loans tend to be a little bit higher. So, I mean, I've got a commercial loan and had a line of credit associated with that was about 8%, Tony. That was the interest rate. Yeah. Yep, exactly. So that was the interest rate. Now, your 30-year mortgages, which is probably more applicable to most people out there listening, was a little bit lower. Okay, so you were talking sevens, somewhere in the sevens for a 30-year mortgage. And so these interest rates and what the Federal Reserve does has a huge impact. I mean, I wouldn't say credit cards are really too much effective, because even when rates were lower, those things were still up in the 20s for some people, 20% interest. And so I don't know about credit cards, but the lines of credits, commercial loans, commercial buildings, your home loans, mortgages, those kinds of things is and let's face it, Tony. I mean, almost everybody has a mortgage, right? So it affects a significant amount of the population. Okay. And so when the Federal Reserve lower rates, that's obviously, good for people borrowing money. Not so good for people that are saving money. And CD rates have been extremely high. Well, I would say extremely high compared to where they were, because before they started raising rates in 22, I mean, you were talking, 1-2% on CDs. Well, then very quickly, by the way, it went up to 5 or even above 5% on a short-term CD. And so people that were saving money, man, they were thrilled with that, right? I mean, and I said, listen, don't, because they would say, well, should I invest this money or whatever? I'm like, yes, but put a certain portion of your dollars in that CD, and there's nothing wrong with that. Yeah. Now, as you know, Tony, and I know, at the end of the day, you have to look at your real rate of return. And your real rate of return includes two things: taxes. Okay. So that 5%, reduce that for whatever tax rate you're in. And then the second thing is inflation. So you factor those two things in. And when inflation was at 5 and you're paying taxes, you actually weren't getting ahead by that much on your real rate of return.
Yeah.
But still 5% CD felt really good. And so anyway, that's the point. So what are we talking about now? We're talking about the future, to say, hey, the Federal Reserve has already indicated that in the coming months, maybe by what I've heard is the mid of next year, they're going to reduce rates a quarter at a time, 3, 4, or even maybe 5 times by the mid next year. Now, who knows what happens? And again, we've got a big change here with, like you said, the political landscape is changing significantly.
Yeah.
So we don't know if that, plays out. Obviously, one of the things that would pause interest rates reductions would be, again, is if inflation kind of ticked up again. So if that happens, they're not going to reduce rates. Okay. But when you're talking about, as a cut in interest rates, the credit cards and the lines of credits that you have, a lot of times those move instantly. So like your mortgage, obviously you're locked in, right? Unless you did an adjustable rate mortgage, which, I mean, Tony, I don't know about you. I haven't heard of anybody doing an adjustable rate mortgage just because long-term rates were so low.
Well, yeah. Yeah,
But
crazy.
but when they got up to 7 and 7.5%, maybe they did. I don't know. Maybe they considered an
Yeah.
adjustable rate mortgage.
Yeah, I don't know. Arms are tough.
Right?
Yeah,
Yeah.
yeah.
I mean, they
I mean,
can be beneficial because, like I said, when rates went up to over 7%, that's one of those things where, okay, well, let's just go with this adjustable rate. I don't know, but I didn't, I don't have a lot of people that have those, I guess is what I'm saying.
yeah.
All right. So let's take a look at an article here. The Federal Reserve just cut interest rates by 0.5 point. Here's what that means for your wallet. We're going to highlight some things. And it actually is highlighting mortgage rates, something in the area of great interest of most people. 15-year, 30 years, pretty, typical, either 15 or 30. And it does say here that the 30-year fixed rate mortgage, 6.3%. Okay. So 6.3%. I mean, now you're getting into more of an average. Like, folks,
Yeah.
3% is not an average. Like,
No.
people got upset. Oh, it's up to
Low.
4%. What?
Yeah.
4% is great.
Yeah. I remember our first home when we first looked at houses, my wife and I, when we were first married. It's been a couple of days ago. Interest rates were about 12, 13, 14%.
Right.
I mean, 14% on a mortgage. I mean, think about it. And we were excited when we got it down to 9%. Our first mortgage was
there you go.
under 10. Single digits was an accomplishment back then. But now our current mortgage is at 2.9%.
All right.
So we're not touching that, and we would like to move. We'd like to now that all our kids are out of the house, so we're thinking about downsizing, but we're not going to do it when the rates are 9%. We want them to go down a bit, but you get down closer to that 5% where we might be headed, according to what you're saying. I mean, the Fed already lowered it by 0.5% or 50 basis points to 5% from 5.5. They're probably going to go down again. The talking heads and the experts out there are saying they'll probably lower it again this month. So we'll see.
Right. Yeah, you never know. And, I think you're making the right move, Tony, about, waiting. Every indication shows that they're going to continue to come down. So I like your strategy. Another big question I get is as these rates come down, people did get a mortgage at 7.5%. At what point is it worth it, paying the fees and those kinds of things to get to refinance? What point is it worth it to refinance? And my general rule is 2%. So if you were at 7.5 and it goes down to 5.5, usually I would recommend somebody refinance at that point. Yeah. Prior to that, maybe not. The other part that you have to take into consideration when you're thinking about refinancing is how long are you going to stay in this house? Right. So if you're going to move in the next year, 2, 3, 4 years, you may not want to refinance because it's just not worth paying the fees to refinance.
Right. Exactly.
Yeah. It's not like you can transfer that mortgage rate to a buyer. So, that's something I would definitely consider when you're talking about, refinance, because I've gotten that question a lot lately because of the excitement around, rates being, cut over the next, 6 months. According to, the Federal Reserve and their meeting notes, significant amount of times. And again, that, things happen and that may not come to fruition, but it does look like it. Yeah. So, all right, the next thing here is auto loans. Okay. So the picture for auto loans is also a nuance. Okay. Auto loans are fixed typically for, 5 years, 6 years, and up to 7 years. But higher sticker prices and higher borrowing costs have hit many auto buyers pretty hard. Right now, Tony, the average rate on a 5-year auto loan is more than 7%, a significant jump from 4% most people were seeing before they started increasing the interest rates. So now, listen, that's the same kind of thing. Like if Fed rates cuts continue to happen and they drop below, refinancing that vehicle again, are you going to keep the vehicle or are you going to sell it a year? Don't fool yourself either. People say, oh yeah, I'm going to keep it forever. No, you're not. Why do I know that? Because you've changed cars every 2 years for the last 10 years.
Right. Yeah. Now you're probably not going to change your,
Let's get a little truth serum, on that topic. So anyway, yeah. So looking at it and being realistic and saying, okay, now I will say this, to refinance an auto loan, you don't have the fees typically that you have if you're redoing your mortgage and those things. So it's a little bit less of a big deal to keep that car.
And your credit actually affects that even more with auto loans.
It
You can
does.
still they have specials, and you can get some low rates if you have really good credit still on a new car, not on used. But you can shop around if you. That's another reason to keep track of your credit score and work with a financial professional, because you can plan for these things or save up cash, right?
Yeah, absolutely. Saving up cash is always the deal. Like if you
Yeah,
want to buy a car, I always say, build up as much cash as possible. Use the equity in your current vehicle, build up some cash, and then that way you don't have to get a loan on the next vehicle. That's
right.
always the preferred way to go. But sometimes, you got to do what you got to do. So I understand that.
True.
But, when you're talking about, let's go, I want to address one thing. I bought a new truck here this year, Tony, because I actually was in a pretty bad accident, and they totaled my old truck, and so you get the insurance payment for that,
Sure.
and so I went to go buy a new truck, and they said, "Well, do you want to get a loan?" And typically my answer is no. He said, "Well, we have a special right now at 0.9%." Okay. 0.9%. Now it's for 3 years, so the payments are a little bit higher, but that's okay. I'd rather, have my money. And again, like we just talked about, you have money markets paying 4.5 to 5, even over 5% in some cases. Well, that's come down. Let's just call it 4.5. So if I don't pay cash, keep that in my money market and earn 4.5, but then yet pay 0.9, like I'll let that
You're
interest just
coming out ahead.
way ahead.
It's
I
called
mean,
good debt. There's good debt and bad debt,
well, it's
right?
called arbitration, is what it's
Yeah,
called.
there you
When
go.
you're paying 0.9 and you're getting 4.5, that's positive arbitration between the two rates in my favor. That's why it's called positive arbitration. If it was negative, then that would be negative arbitration. In other words, I'm paying 7 and I'm only earning 5. That's negative arbitration between those two rates. So positive in your favor, negative is obviously not. So,
Yeah,
you know,
makes sense.
yeah. So I'm doing that now. The one caution I will throw out to people, because I hear, other people have obviously, I'm not the first person to ever do that.
Right.
But one, caution I would throw out there is that, make sure you stay disciplined to that, right? So we're not taking out a bunch of money out of that money market that's paying us that higher rate to pay for something else when it was really meant to, buy a newer, pay that payment for that new vehicle. Does that make sense? So
Yep.
all of a sudden, you're 2 years into a 3-year loan and you go, well, crap, I don't have any more money in that money market because I used some of it to go buy a whatever. And so stay disciplined. If you're going to take that approach, it's good. It's okay. You get that positive arbitration, but be careful. Okay. Don't be disciplined, in other words, and stick with that plan, and don't touch that for other stuff. Okay. So that's the only danger I would say there to watch out for. Next is student loans, Tony. While federal student loan rates are fixed, people with those loans won't immediately be impacted by the most recent rate cut. So, you're still at that fixed rate, in other words. But the story is different if you have private student loans, Tony, which have either a fixed rate or a variable rate that's tied to the Treasury, 10-year Treasury typically, or other rates. Okay. Once the Fed starts cutting those rates, the variable interest rate loans obviously will come down. And sometimes those are over a 3-month period, 1-month period, depending on, the loan's benchmark language. So you got to be careful and read those loan docs. But, what I would say about that is, that's been a big topic, right? Student loans and the amount of student loans that we have in this country. That's a big, big deal.
Yeah, crazy.
Yeah, exactly. And then the interest rates went crazy too. I mean, I remember I got a little bit of a student loan. I had a scholarship to run track at SEMO, and so I had I had to pay for a little bit of my school, so I got a little loan, and I remember, Tony, it was like 2.5%.
Right.
It was nothing, and then all of a sudden, everything starts changing, and then all of a sudden, student loan rates are 10, 11%. I'm like, what? I cannot believe this. And a lot of it's because of these deferments, forbearances, all these kinds of different terms that are in these loans, and their income-driven payments, all this kind of stuff. You got to be aware of what you're signing. Don't just sign a loan document and say, okay, I'm borrowing this much money and it's this rate. No, there's things in there that trigger negative impacts on your life.
Yeah.
So
Yeah.
be aware of those things. Read those loan documents. talk to somebody that
So
understands.
many students and parents do not know what they're signing. They think, oh, student loans, everybody does this. My kid needs it, or I need it. And so they just do it and they don't know what they're getting into. This is yet another reason why you want to consult with a financial services professional, because you might recommend an attorney that look it over,
Right.
or tell them, hey, there are other options and strategies you might want to consider as
Right.
well. Or maybe it is the best thing. Maybe the student loan is a great deal for them. But you're right. There are so many people that get themselves into big trouble with student loans.
Yeah.
Plus, I mean, the fact that people are taking out student loans to the fact that people are taking
Yeah.
out student loans to pay for degrees that aren't going to get them jobs that will be able to pay back the loan. In other words, if you're taking
Right.
out a $200,000 student loan to get yourself through college and you've got a French poetry major, are you going? The rule of thumb is you need to get a job out of college that's going to, the yearly salary is what your
Yeah,
loan is
that's a
for,
good point too. Yeah, absolutely.
right? I mean,
Yep. So the last thing I want to talk about before we go, we're running close on time here, guys, is savings accounts, right? We talked about the high yield money markets. We talked about CDs. Listen, all of those things, we hit the peak on those. You know, when you were getting 5.25 on a money market, that's already come down to 4.5. It's going to continue to come down. CD rates are going to be maturing. Those are going to be lower rates. So it's time now. So I've been telling people, yeah, just keep it in a CD. But now as these things come down to 4 or less than 4, you need to look at other options, and we can help you with that. So, give us a call at Alspaugh Wealth Management. We've got other alternatives to look at from an investment perspective that will keep your money more conservative, but still, maybe get a little bit better than what the bank will pay you. So anyway, something to think about. Listen, this has been a lot of fun, Tony. A lot of fun.
Yep.
There's a lot of information out there. There's a lot of
Good show.
impacts on interest rates and how it affects people. But ultimately, if you need help to understand all these things, just give us a call, 573-332-7855.
All right. Sounds great. Thank you so much, Brock. And listeners, that does it for today's episode of the Retirement Playbook with our host, Brock Alspaugh.